Hey everyone, given the recent volatility we've seen in the stock market, I thought it may be a good idea to share something with you that's a little different from our normal content. Most of you know that my day job is a financial planner who helps people who are nearing or already living in retirement. And occasionally, especially when things get rough in the market, I'll make a video that's exclusively for the clients of my firm. It's not released to the general public on YouTube. And after the market dropped a few days ago, I made a video and sent it out to my clients. And then the market made a recovery. And then it dropped a lot. And as of the time I'm recording this, it's still going down. So with these gyrations that we're seeing, I thought I'd share this video with my broader audience in hopes that it may give you some perspective for the days ahead. Here it is. Hey everyone, if you've been watching the news or the balances of your accounts, it's no secret that this year hasn't been kind to your account value. We're getting hit with inflation numbers like we haven't seen in decades, and this is affecting just about everything you can invest in. As of the time I'm recording this, the 500 largest stocks in the U.S., as measured by the S&P 500, is down about 13%, and we just finished the worst month since 2008. And if that's not bad enough, the bond index, those investments that are supposed to be a hedge against stock market losses, are down about 10%. Unless you have all stocks in your portfolio, just about everything else is at a loss for the year. The big question that most of us have is, will it get worse? Well, it could. Just the other day, the market closed below its 200-day moving average. Now, I don't get too hung up on charts or technical analysis, but this does show a potential downward trend developing. Now, only time will tell, and we'll only know the results in hindsight, but this does raise another big, obvious question. What should we do? Well, if you've been a client of mine for long, you know how I feel about timing the market. It sounds nice, but it just doesn't work. And this isn't just my observation. This has been backed up by numerous academic studies published in the Financial Analyst Journal, the Journal of Financial Research, and lots of other noteworthy publications. Now, in past videos, I've shared lots of data and charts that show why trying to avoid the bad markets doesn't work very well. But I want to show you one of the most compelling statistics I've seen. Let's lay the groundwork first. Over the past 30 years, if you were fully invested in the S&P 500 index, meaning you never tried to time the market, you just put your money in and walked away, a $10,000 investment would have turned into $114,000 at the end. Now, that does not include reinvesting dividends. That would have changed the results and made them look a lot better. But I wanted to keep this simple and clean and just look at price movements. So $10,000 would have turned into $114,000. If we go back over that identical time period and start with $10,000, except this time we take out the best 30 days in the market. Instead of having $114,000 at the end, your $10,000 would have turned into less than $20,000. For missing just 30 of the best days, you would have received a return that was 82% lower. And here's where this gets interesting. Where did those 30 days happen? This starts to tie it all in together. Well, first, let's highlight the bear markets. This is defined as a period where the market declines by 20% or more. You can see since 1992, there have been 4 bear markets. When we look at the 30 best days, 15 of those days happened inside the bear markets. And most of the other best days happened very close to the end of the bear market. That means that if you would have just sat on the sidelines and waited for the bear market to pass, everything to get back to normal and get the all clear, your return wouldn't have been anywhere close to the return of the person who just waited it out and stayed invested. So I know these markets are painful and they may get worse before they get better, but our approach is not going to change. Time in the market has always been better than timing the market. But this doesn't mean that we should be completely passive in our approach either. A portfolio still needs management to keep up with the adjustments and tune-ups it needs. An example of this would be the move that we made earlier this year when we reallocated some of the funds in the S&P 500 market-weighted fund to an S&P 500 equal-weighted fund. Or when we decreased the allocation from a tech-heavy fund to one that had broader diversification. But one thing we didn't try to do, time the market. And that's not going to change. So if you didn't catch anything else I said, here's the message in one succinct sentence. Everything is going to be okay. Relax and don't worry about it. I found that in periods like this, the best thing you can do is not check your account balances as often, and don't listen to the financial news like CNBC or Fox Business. Those companies have realized that fear will get them more clicks and views than anything else they've offered before. And over the past few years, they've gotten better and better at creating headlines to get your attention with fear. Above all else, their job is to get viewers and readers, and delivering actual information is secondary. So again, that's a video that a few days ago was sent to my clients. Now, you'll notice my message was to stay the course, but that's because I have a plan for each of my clients and an investment portfolio that matches that plan. While my advice is still stay the course, that really only applies if you have the right allocation in your portfolio that matches your individual and specific plan. If you have the wrong investments or don't have a well-defined plan, this is the time to review and make changes. If you need some help or just want a second opinion, I put a link down below where you can get in touch with my firm. Thanks for watching.